Today's tech news moves fast, but understanding it shouldn't be hard. That's why Snarful Solutions Group brings you Connecting the Dots, where we break down what's happening in tech and why it matters to you. Now, let's dive in with your hosts.
Welcome to Connecting the Dots, coming to you from Snarful Solutions Group in Sacramento, California. I'm Alex.
And I'm Morgan.
And today is Wednesday, May 27th, 2026. We've got a lot to cover today for you.
We really do.
Yeah, we're basically looking at this massive real-time collision happening across the globe. You've got artificial intelligence software evolving at just this breakneck pace.
Right, running autonomously on our desktops now.
Exactly. But on the other side, the actual physical supply chain, the hardware you need to run that software is just, well, it's being pushed to its absolute breaking point.
The massive bottleneck.
It is. And it's warping the global economy. And honestly, the shockwaves are heading straight for your wallet. But before we get into the heavy tech and market stuff, let's take a quick look at the national radar because, you know, the physical world is honestly just as chaotic today.
Oh, absolutely. If you're traveling, it is a mess out there.
Yeah, the map is incredibly active. We're currently looking at 374 active U.S. weather alerts. Yeah, and 113 of those systems are sitting right over land. So definitely double check weather.gov if you're heading to the airport or, you know, starting a road trip today.
It's genuinely a messy map across the Midwest and the South right now.
Very true. Bringing it home here to Sacramento, though, we are actually incredibly lucky today.
We really are.
Yeah, it's a very comfortable 72 degrees Fahrenheit outside. We've got partly sunny skies, a slight chance of some light rain later this evening, and just a really mild 6-mile-per-hour wind.
Honestly, it's the kind of weather that almost makes up for the absolute heartbreak local sports fans had to endure yesterday.
Oh, man, do not remind me.
I have to. Tuesday, May 26th, was just a brutal day on the diamond for Northern California.
I am still recovering from that. I mean, up in San Francisco, the Giants dropped just a really frustrating game. They lost 5-7 against the Arizona Diamondbacks.
Yeah, Eduardo Rodriguez secured the win on the mound for Arizona.
Right. And then looking over at Oakland, I mean, the A's didn't offer any redemption at all. They fell 1-4 against the Seattle Mariners.
Emerson Hancock pitched an incredibly solid game to lock in that win for Seattle.
Yeah, he did. Not our finest showing, though.
No. The only silver lining is that the Sacramento Kings actually had the night off, so we were spared any NBA-induced stress.
Which my blood pressure definitely appreciates.
Seriously.
But speaking of high stress, we do have to talk about the financial markets. Looking at yesterday's close on May 26th, the Dow Jones finished at 50,461.68.
So a bit of dip.
Yeah, that represents a slight daily drop of 0.44%, though the index is still holding on to a 1.54% gain for the week.
Right, and the S&P 500 managed to tread water, closing at 7,519.12, which is up just a microscopic 0.10% for the day.
Then there is the crypto market.
Yeah, that's the interesting one right now.
It is. As of this morning, Bitcoin is sitting at $75,189.98.
And it's been dropping.
Right. It's been actively bleeding capital over the last few days. And it's not because people are like cashing out to buy bonds or something safe.
No, not at all.
Capital is abandoning crypto right now because Wall Street has an absolute insatiable appetite for AI hardware. I mean, the institutional money just isn't interested in digital scarcity anymore. They are fighting tooth and nail to buy up the physical companies that make artificial intelligence actually function.
It's a complete shift in momentum.
It really is. So let's unpack this right after a quick word from our sponsor.
Today's episode is brought to you by Strong Coffee, the premium instant coffee that tastes like a traditional brew, but is packed with 15 grams of protein, MCTs, and adaptogens like ashwagandha. Get clean, sustained energy without the jitters. Use promo code SNARFUL for 20% off at strongcoffeecompany.com.
All right, we are back, and we're jumping straight into today's Morningstar Tech article report.
There's a lot to get through.
Definitely. The undisputed stars of the show today are the companies that physically manufacture the memory chips, the ones required to keep AI data centers from just choking on their own data. We are talking about a full-blown trillion-dollar memory boom.
Yeah, the financial milestones that hit the wire yesterday are genuinely difficult to wrap your head around.
They really are.
Take Micron Technology, right?
Yeah.
They're one of the premier memory chip makers on the planet. Their stock surged 19.29% in a single trading session yesterday.
Which is just unheard of for a company that size.
Exactly. That explosive jump pushed its market value past the $1 trillion mark for the very first time.
Let me put that into perspective for you, because earlier this month, literally the first week of May, Micron was valued at $700 billion.
Right.
So they generated $300 billion in enterprise value in just a few weeks.
It's staggering. And they weren't alone either. SK Hynix, which is the massive South Korean semiconductor company, they jumped 9.9%, officially crossing that $1 trillion threshold as well.
Wow.
Yeah, they're now only the third Asian company in history to do so, joining Samsung.
But, looking at these numbers, I think we really need to explain the mechanics of what is actually happening inside these data centers. Like, why memory and why right now?
So, to understand the demand, you really have to look at the architecture of a modern AI server. When people think of AI, they usually picture the massive processors, right?
Right, like the GPUs built by companies like NVIDIA.
Exactly. Those processors are the brains doing all the incredibly complex math. But here is the catch. A processor that fast needs to be fed data at just a staggering velocity.
Okay.
If the memory feeding it is too slow, you hit what computer scientists call a bottleneck.
Right. The analogy I keep coming back to is it's like dropping a high-performance Ferrari engine into a car, but then trying to supply it with fuel through a tiny plastic coffee stirrer.
That's a perfect way to look at it.
It doesn't matter how powerful the engine is, it's just going to stall out waiting for the fuel to arrive.
And that is the exact mechanical problem the industry is facing right now. So to solve it, server farms require something called high bandwidth memory, or HBM.
HBM, right.
And unlike standard memory chips that just sit flat on a motherboard, HBM chips are actually stacked vertically on top of each other.
Wait, really? Like physically stacked?
Yes. Microscopic layer by microscopic layer. And they do this to create a massive multi-lane highway for data to travel directly into the processor. And alongside HBM, they're demanding astronomical amounts of LPDDR5 memory as well.
LPDDR5 being low-power double data rate 5, right?
Right.
That's the same highly efficient memory architecture we originally developed to save battery life in smartphones, isn't it?
Precisely. Because in a sprawling data center that houses tens of thousands of servers, electricity and cooling are the real limiting factors.
That makes sense. They generate so much heat.
Exactly. They desperately need the data speed, but they also need it to run cool and basically just sip power. And right now, the global demand for these highly specific, incredibly difficult to manufacture components is so intense that analysts expect severe hardware shortages to stretch well into 2028.
2028? That's wild.
Yeah, UBS actually just tripled its price target for Micron to $1,625 a share because they see these manufacturers locking massive tech companies into long-term agreements. And with partially fixed pricing, the chip makers hold all the leverage.
Yeah, it's the classic strategy of getting rich by selling picks and shovels during a gold rush.
That's exactly what it is.
I mean, everyone in Silicon Valley wants to build the next billion-dollar AI software platform, but every single one of them has to pay the toll to the companies physically stamping out the hardware.
Right.
But here is where this gets critical for you, listening at home. We've talked about massive enterprise data centers, but what does this mean for the everyday professional or family looking to buy a new laptop or phone? Like, what is the actual mechanism that connects a corporate server farm upgrade to someone buying a Chromebook?
Well, it really comes down to factory allocation. You can't just build a new semiconductor fabrication plant overnight.
Right, they take forever to build.
Yeah, they cost upwards of $20 billion and take years to construct.
Yeah.
So to meet this ultra-profitable demand for AI server memory, companies like Micron and SK Hynix have to pivot their existing manufacturing lines.
Oh, I see.
Yeah, every factory line dedicated to stamping out an HBM chip for an AI server is a factory line that is no longer producing the standard memory chips used in your smartphone or your kid's school laptop or the solid-state drive you want to buy for your home office.
So it's a direct zero-sum game.
Exactly.
The supply for consumer electronics is actively shrinking, even though everyday consumer demand hasn't really changed.
Yes, and the major research firms like IDC and Gartner have published very stark warnings about this. They're projecting that this global supply squeeze will cause significant declines in the overall shipments of PCs and smartphones.
Because they literally just can't get the parts.
Right. Because standard memory is becoming scarce, it is becoming wildly expensive to source. So they expect sharp price increases to hit retail consumers by the end of 2026.
So if you have a laptop that is on its last legs, waiting another 6 months to replace it is likely going to cost you a huge premium.
Unquestionably.
Wow. Moving on to our next story, let's look at the macroeconomic fallout of this dynamic. Because when you have hundreds of billions of dollars funneling into a tiny handful of overseas manufacturing giants, it begins to drastically warp global financial markets.
It really does.
It's creating historic and, frankly, deeply concerning concentrations of wealth.
Yeah, we really have to examine South Korea's KOSPI index to see just how extreme this has become.
The KOSPI is their benchmark stock market index, right?
Yeah.
Kind of similar to the S&P 500 here in the States.
Exactly. And yesterday, it hit 8,228 points.
Which means what, exactly?
That means the entire index has doubled year to date, a 100% gain in 5 months. To find a rally that aggressive in the Korean market, you have to look back to the speculative mania of 1999.
1999. But when you actually open up the hood of the KOSPI index, you realize the entire thing is practically being driven by just two companies.
Yep.
Samsung and SK Hynix, the two AI memory titans we literally just discussed, they now make up 47% of the index's total weight.
Which is incredibly top-heavy.
It is. And it gets crazier. Those two companies alone account for 72% of the projected net profit for the entire South Korean stock market.
It's just a massive structural distortion. I mean, if you calculate the index's performance by removing those two specific hardware giants, the rest of the South Korean market has only gained about 30% this year.
It's like watching a massive cargo ship trying to cross the ocean, but it's being powered by just two completely overloaded outboard motors strapped to the back.
Exactly.
It is moving incredibly fast, but the mechanical stress on those two motors is immense. And what baffles me is that Wall Street seems perfectly comfortable with this risk profile. I mean, Goldman Sachs just called the KOSPI their highest conviction trade in Asia. They're boldly projecting a 300% earnings growth for 2026.
They are very bullish on it.
They are. But I look at this and I see massive red flags. With the KOSPI showing extreme volatility, like the 12% single-day crash we saw back in March when Middle East tensions flared up, aren't we just looking at another 1999 dot-com bubble waiting to pop?
Well, that is the critical question. But there is a fundamental difference in the underlying mechanics of this rally compared to 1999.
Okay, what's the difference?
Back in the late 90s, companies were being awarded billion-dollar valuations based on just eyeballs and entirely theoretical future revenue models.
Right, pets.com kind of stuff.
Exactly. Today, the valuation of Samsung and SK Hynix is backed by verified historic cash flows. That 72% of projected net profit isn't a guess. It is tangible cash being paid by the biggest tech companies in the world to secure their spot in the memory supply chain.
Okay, that makes sense on paper. The money is real today. But, I mean, the semiconductor industry is notoriously cyclical, isn't it?
Very much so.
So if the demand drops even slightly, doesn't the whole house of cards come down?
That is the exact vulnerability, yes, and why this market has zero margin for error. Semiconductor fabrication plants have astronomical fixed overhead costs.
Right, keeping the lights on in a $20 billion factory isn't cheap.
Exactly. They have to run at near maximum capacity to remain profitable. So, if big tech companies suddenly decide to slow down their AI spending, maybe they realize their new software features aren't generating enough subscription revenue to justify the massive hardware costs, well, the orders for those memory chips will pause.
And then what?
If chip demand softens, those massive factories still have to pay their fixed costs, which instantly crushes their profit margins. If that happens, that cargo ship powered by two outboard motors stalls out violently.
Which perfectly explains why we mentioned Bitcoin sentiment being in the gutter earlier.
Yes, exactly.
Capital is inherently pragmatic. It flows to the path of least resistance and highest verifiable yield. I mean, why would a hedge fund gamble on the theoretical future value of a digital token when they can buy equity in a memory chip manufacturer that holds a literal monopoly on the physical hardware powering the current technological revolution?
They wouldn't. The AI hardware narrative has entirely absorbed the liquidity that typically fuels crypto bull markets. Institutional investors are currently rewarding tangible, bottlenecked physical production over digital assets.
Okay, let's look closer at the software side of this equation, because we've spent a lot of time talking about the servers and the chips. But all of this multi-billion-dollar hardware is ultimately running code.
Right.
And the software advancements we're seeing this year completely justify the hardware panic. I mean, we are living through the AI agent revolution right now on our own personal desktops.
We really are witnessing a fundamental leap in human-computer interaction.
It's wild.
For the last few years, the public has interacted with AI primarily as a chatbot. You ask a large language model a question, and it prints out text on a screen.
Right, very conversational.
But today, we are moving to autonomous agents. These are AI models that are granted local permissions to interface directly with your computer's operating system. They take actions, and they run automated workflows on your behalf without you having to guide every single step.
And the catalyst for this shift really kicked off with Anthropic's Claude Code, right? Specifically their Opus 4.5 model.
Yes.
To give you an idea of how competent this model is, Anthropic challenged the AI with their own internal, notoriously difficult take-home engineering exams.
These are the exact same exams they give to senior human developers.
Right. And Opus 4.5 scored higher than any human candidate they had ever tested.
It's incredible. That level of logic and reasoning is truly paradigm shifting. But the real explosion happened when the open source community got their hands on these capabilities.
Oh, for sure.
A developer named Peter Steinberger launched an open source tool called OpenClaw. It essentially acts as a secure bridge, allowing anyone to bind a powerful AI model directly to their computer's file system.
Which lets it execute shell commands and run autonomously in the background, right?
Exactly. And it resonated so deeply with the tech community that it racked up over 366,000 stars on GitHub by early May.
Wow. You know, I think a lot of people hear the term AI agent and they assume it means the software is going to autonomously write the next great American novel or architect a new rocket engine from scratch.
Right. They imagine sci-fi scenarios.
Exactly. But the most profound real-world application of this technology that I've seen recently was much more grounded. It was a story from XDA developers about a guy who integrated Claude Code into his 3D printing hobby.
Oh, I read about that. That specific use case is the perfect illustration of what an AI agent actually excels at today versus what we culturally imagine it doing.
Right, because this user didn't ask the AI to do the highly skilled expert work. He didn't ask it to analyze his 3D models and generate complex slicing parameters.
No, because it wouldn't know how.
Exactly. He didn't ask it to precisely tune his filament temperature profiles because the AI doesn't understand the physical ambient humidity of his real-world workshop.
Right.
Instead, he deployed the AI agent to handle the chaotic, mind-numbing administrative tasks that were just cluttering up his digital workspace.
Which is such a smart way to use it. Like many digital creators, his file system was a total disaster. He had this sprawling directory filled with randomly named export files, scattered text notes, and old project revisions that were just impossible to navigate.
So he unleashed Claude Code to act as this relentless digital assistant. He instructed the agent to build scripts that would automatically scan his folders and consistently rename his messy STL and 3MF files.
And for those unfamiliar, an STL file is a basic 3D geometry file, and a 3MF file is a newer format that includes extra data like color and materials.
Exactly. He had the AI automatically archive his old project folders so they were out of sight, but still securely backed up. He even gave it permission to scan his completed design directories and automatically write up and generate RIA-DME files.
So smart.
Right. So a month later, he wouldn't have to struggle to remember how he built a specific part.
What he did was leverage the AI to construct a clean, highly repeatable infrastructure around his creative process.
Yes, and I love the analogy of viewing an AI agent not as the master craftsman of your digital workshop, but as the shop vac.
That's a great analogy.
You do not ask a shop vac to carve the intricate joinery of a custom wooden chair. You use the shop vac to aggressively suck up all the sawdust and debris so that the master craftsman, which is you, has a clean, unobstructed space to actually work.
Yes.
But this brings us to a critical warning. Why is it so vital that working professionals learn to keep automation in its lane rather than treating it like a magic wand?
Because it leads to a very common trap known as automation overreach. When you grant an AI agent access to your file system and let it run scripts autonomously, it is remarkably good at making your environment look highly organized.
Okay.
But it can easily base that organization on fundamentally flawed assumptions, and you might not notice until it's too late.
Walk me through how that failure mechanism actually happens in practice. What does that look like?
Let's stick with the 3D printing workflow. Imagine you ask an AI agent to automatically scan all your 3D models, calculate the exact material cost based on filament weight, and package those estimates into a beautifully formatted spreadsheet.
Okay, sounds super helpful.
It looks incredibly professional and authoritative. But what if the AI pulled the volumetric data from an outdated larger version of the file? Or what if it simply hallucinated the incil density because it couldn't properly parse the metadata of a specific 3MF file?
Oh, I see.
The final numbers are entirely wrong, but because the automated agent presented them so cleanly, human psychology dictates that you are highly likely to trust them blindly.
So the danger isn't that the AI fails. The danger is that it fails confidently, wraps its bad data in a pretty spreadsheet, and tricks you into turning off your own critical thinking.
Precisely. If an autonomous script renames your files incorrectly based on a hallucination, it can corrupt a massive project directory. If it archives the wrong folder, it essentially hides critical data from you. When you abdicate the thinking to the machine, you lose the granular, intimate understanding of your own work. True expertise still fundamentally requires human judgment.
Definitely.
The genuine power of these AI agents today isn't replacing human experience. It is strictly about reducing operational friction. Let the agent handle the naming conventions, the sorting, the filing, all the repetitive drudgery so that your human brain retains the energy required to solve the complex, highly nuanced problems that the AI cannot even perceive.
It really is about respecting your own craft. Let the AI sweep the floor of your workshop, but you must remain the one making the cuts.
We'll be right back to wrap things up.
Before we wrap up, a quick thanks to Old Glory, an iconic music and sports fan merch store. Perfect for the techie in your life. Use promo code SNARFL for 15% off at oldglory.com.
All right, as we pull all these threads together for you today, it is genuinely fascinating to watch the complete life cycle of this technological leap playing out simultaneously.
It really is. I mean, we started at the macro level, right? The insatiable global demand for data center power is creating trillion-dollar hardware titans out of companies like Micron and SK Hynix,
which is, in turn, heavily warping global stock markets. We're seeing major indices like the South Korean KOSPI being pushed to historic and really highly precarious heights.
Yeah, propelled almost entirely by the physical manufacturing constraints of high bandwidth memory chips.
Exactly.
And finally, we see how that massive macroeconomic hardware boom trickles all the way down to the micro level of your personal computer. These insanely powerful chips are what allow software models to become advanced enough to power open source AI agents like OpenClaw.
Right. Agents that can seamlessly organize your messy digital life, provided you use them as a tool to reduce friction and never let them outsource your own critical thinking.
It is an incredible interconnected chain of cause and effect spanning from raw silicon all the way to autonomous software.
It truly is.
And it leaves me with one final thought for you to mull over as you navigate your day. If open source AI agents are already acting autonomously on our devices, and they're successfully writing their own code and actively expanding their capabilities month over month, what happens when the software intelligence evolves faster than the global supply chain can physically produce the memory chips required to run it?
That's a scary thought.
It is. We might be steering toward a physical bottleneck, unlike anything the technology sector has ever experienced.
We're here to help at Snarful, so reach out on our website if you have any more questions.
That's a wrap on today's top stories. Remember, tech doesn't have to be complicated, and we're here to help connect the dots. If you've got questions or want to learn more, visit us at snarful.com. Thanks for listening, and we'll catch you next time.